On this episode, we talk about Coinbase going public, Shopify firing everyone, and is diversification for idiots? Welcome to Think at Heart.
That was good. Good start.
Oh, man. That'll get people's attention, eh? Firing everybody,
so.
Diversification for idiots. Jeez.
Those
You can tell I'm going squirrely with the new lockdown.
Yeah.
I'm just getting aggressive. There's nothing else to do. There's nowhere to take it. When I started running again just because I was bored, you know?
Yeah. How's that going?
Yeah, nice, actually. It's a nice way to start my morning. Thanks for asking.
It certainly is.
Anyway, welcome to episode 15, Think at Heart. I'm Scott Goodfellow. This is Ben Hart, Hart Investment Group,
Hello.
National Bank Financial. Find us on all major social media platforms. Okay, let's get going. So, what have you been doing? What have you been doing under this lockdown? We're like 2 weeks in. Kids are off for this mock spring break. Now we find out they're not going back to school. Are you going nuts yet?
Well, which I don't know if we discussed before, but my middle daughter, they had a COVID scare in her class. So she's been home for, I guess this will be 3 weeks now. And my youngest decided we kept her home too. So Brooklyn and George have been home for 3 weeks, looking like another 3 weeks of school. And so it's not ideal, but we're gonna make it work. I had them out tonight. Lucas and I went for a run, and the girls biked. So got to keep moving.
Yeah, I know we got the stay-at-home order, but we gotta stay active, right? We gotta find a way to stay active. Which kind of brings us to the first point: is like, even though all these things are closed and it should be having a negative effect on the economy. I read a couple of stats here that I'm going to read out. Like, retail sales up almost 10%, sporting goods sales up almost 25%, clothing up 18.5%. Not to mention the housing market is insane in most areas of North America. Like where we live in Ottawa, the places are going now. I heard somewhere went for like 300,000 over ask last week. We live in a suburb that typically, the average sale price is 500,000 for a 4-bedroom house, and now we're definitely over $1 million for these areas. It just seems like, we should be in a slowdown and people should be conserving, but people are just spending money. It's insane. Tell me about that. Why is that happening, Ben?
Yeah, so I think about it in, I guess, in multiple ways. Obviously, each city, each country is different. Ottawa, as we've talked about before, it's a government / tech heavy city. So you haven't had a lot of people lose their jobs in Ottawa, and you've also had the people, the unemployed. Some were making more than they used to make when they were working. So I think that's something that we're seeing there. There is also limited supply in everything from houses to you were talking about bikes before. There's limited supply of everything for I guess 2 reasons. I think houses, because not everybody wants to sell and list and move in COVID times. So I think you got constrained supply that's going to open up. And then the other things, like if you're buying goods like sporting goods or things like that, you're having you kind of got a delay in inventory coming in because a lot of the manufacturing plants have been slow and closed, and you got retailers, we'll say, with the clothes and shoes, they're having massive discount sales trying to clear out their inventory because they got to bring in more inventory. So I think you got a number of things happening at the same time, which I think we talked a little bit about too just before we got on here. You've started to see numbers start to slow down. So all those stimulus checks, which would have been completely spent last year in the U.S., you're not seeing everyone spend that whole amount of money. You actually saw a slowdown in retail sales, and particularly a slowdown in women's wear, which tends to be kind of a leading indicator. They're the one that first tends to either accelerate or decelerate, and so it's a signal to pay attention to. So I think you got constrained supply, which is partially why you got this inflation number. I know we're going to talk about inflation, but you got kind of constrained supply, and as a result of that, things are is not as readily available as before.
Yeah, like I try to find a bike, anywhere. Never mind anywhere in the city. I'm looking online and trying to find a bicycle,
Yeah,
and cannot find one
yeah,
anywhere. Right? It doesn't
yeah.
matter what you want to pay. Sorry, if you want to
Yeah,
go super high end, you want to pay $15,000 for a bike, you could probably get one. But
anywhere. Yeah,
you
yeah,
just want to go middle of the road, forget it, right?
yeah,
And I think that
yeah,
goes to what you were saying about constrained supply. You know, it's insane to me, but
yeah. So I do think it's temporary. I do think as Ontario, I think we're at the end here. And when I say the end, I mean I think we're at the end of the lockdown phase. We got almost 10 million vaccines, or at least people have got close to 10 million vaccination, at least the first round of shots in Canada. Ontario is trying this last lockdown. And I think on the other side of this, we probably have a different environment, and where the economy and market kind of all constrained at the same time just over a year ago, and everyone is panicked. And now I think everyone's kind of panicked what's going to happen on the other side. I think we probably have a slowing economy, which people kind of in, uh, initially think that things accelerate when things open up again. I'm not so sure.
yeah. Who knows, Ben? Who knows what's in store for us here? Okay, well, let's move on
Well,
to something more exciting. The time we've all been waiting for. Coinbase going public. Now,
yeah,
it did not IPO, it was a direct listing. Let's start off by
yes,
just kind of explaining what the differences are. Go ahead.
sure. Yeah, so an IPO I mean, they're quite similar from the perspective that they come to market in a similar format. Like there's a price issued, and that's kind of the price that it gets listed at or valued at in day one, and then it's sold. So an IPO, which is the traditional route, would be one where the listing firm would hire a bunch of investment bankers to go up and drum up business. They sell a portion of their assets. The existing shareholders sell a portion of their business to the investment banks. The investment banks in turn value the business, and they sell it to their retail clients or institutional clients, we'll say. So it's a different format from the perspective that the existing shareholders kind of are locked up to selling a chunk of their business to the investment banks, and then they come to market with a pricing. The investment banks would make their 6-8 points, and then it would come to market from a traditional way. Where a direct listing, where there's enough activity, you don't really need the road shows. You don't really need the investment banks kind of drumming up the business. So of course you go directly to market. You have similar rules and regulations around how you need to qualify. But what it does give is it gives the individual owners the ability to liquidate their positions whenever they want. So, what happens when you do an IPO, like say you're a venture capitalist and you're going to sell 10% of your shares, the investment bank gets to decide what you sell them at. Right. So they
Right.
fix the share price where, if they come to market like Coinbase did yesterday and the institutional owners say, okay, we're going to liquidate, 10% on the first day, and they waited, they got an extra 40-50% upside had they gone through the IPO route. They get
I
to
see.
liquidate into the market whenever they want.
I see. I see. Well, I mean, it certainly has been the most anticipated release of the year.
Sure.
And Did it meet expectations?
Well, I mean, I think I guess I would look at it as it met expectations from the perspective that it opened up with a lot of interest, a lot of demand. We had crypto running up into it, like Bitcoin, Dogecoin, like your favorite, like all these ran up into the IPO. So I think it met expectations from that perspective. I don't think it met the most bullish expectations was they'd hoped that it could get to 100 billion market cap. I think that's the optimists, the maximalists that think that crypto is going to take over the world. So I think it met expectations. It's actually hung in quite well. You know, which one of the things that I did yesterday, which I think we talked about yesterday, but not in real time, was I did reduce some exposure to Bitcoin and reallocate some of those proceeds to the ARC-F, which is Kathy Wood's fintech fund. And Kathy, we saw, who's obviously quite prominent in the tech industry, did in fact actually liquidate some positions in Tesla and bought Coinbase yesterday. So, I think from the perspective of how it's done, it's actually fared pretty well, and hung in better than I think some people thought it would have been just a one day, and then we'd see a massive sell-off, and so we haven't seen that yet.
Yeah, I mean, like you said, it was projected that it was going to go to 100 billion, and people, the naysayers are saying, "Oh, look, it didn't reach 100 billion, it didn't reach 100." But yeah, but it's still a massive opening, and just the size of it alone would put it in the S&P as it is now at like 89 or something like that. So, I mean,
Yeah.
that's a massive, like, that rarely happens. Is that not true?
Oh, for sure. I mean, the one thing that they're going to have, like a lot of these, like tech companies, like Tesla, for example, like Tesla wasn't in the S&P 500 because you actually need to be a profitable company for multiple quarters. Like
Hmm.
you have to prove that history in order to get added to the S&P. Coinbase is a profitable company already. Like this is a
Hmm.
tech company coming to market that generates revenue, that generates free cash flow, that has a good profit margin. So yeah, it's rare that you see something like this happen and trade like it has. So, the one thing it did, and it was a bit of a fear coming into this, is it has sucked money out of some of the other names like MicroStrategy and Galaxy. You've seen some pressure on those stocks. I think as people look to maybe de-risk some of their crypto corporate exposure. And so you've seen money flow out of those names, and I think it's probably gone into Coinbase. You can't actually see the flows, but as you look, there's been some downside pressure in those names, which I think probably are reasonable entries and opportunities if you didn't buy them and you like them. So you've seen some of that happen.
Right. Well, we'll probably see more of that happen, right? As there becomes more and more ways to invest in crypto, right? I mean, those dollars will kind of spread out over all those different vehicles. So, yeah, it'll be
Yes,
interesting to see
yeah,
if that happens.
yeah, so I think so. So the new head of the SEC, which I think officially gets approved at some point this week or next week. So he's very pro crypto, right? So I think everyone's waiting. There's kind of three Bitcoin ETFs that are sitting on his desk technically in the US waiting for approval. And it's highly likely that he gives them the rubber stamp. And if he gives them the rubber stamp, I think that's probably, that really, as we've talked about before, that opens up that opportunity because right now, 401ks and IRAs and these a lot of the retirement accounts in the U.S. don't have any way to participate in it, and
Hmm.
so. Still the money is controlled, at least the retail money in the US is controlled by individual advisors, right? So if
Right.
if you give them away and they're allowed to do that, that's a huge amount of potential capital to flow.
Yeah, for sure. But it'd be
Yeah.
interesting to see if people just add to their positions with these new ways to invest in it, or they take it out and just kind of spread it over the different vehicles. What What do you
Yeah,
think?
so I think yeah, look, it's a great question, but I think just because we sit where we do and we talk about it and we allocate to it, that's not the norm. And I think it's a hard we sometimes you get stuck in that thinking, right? We're just in here and we're like, okay, we do it. It makes sense, right? Natural allocation. Institutions are doing this is another asset class and we think that it makes sense. But still as you go across the country and at least in Canada and you read the statistics in the US, like people aren't allocating to it yet.
No.
No.
Yeah, I think you're exactly right. I think you and I see it as well. Certainly, I do. Maybe you're different, but I just assume everybody knows about it. Everybody's investing in it now, and I think that's not the case, right?
No.
Just
No.
because we just inundate ourselves with it now.
Yeah.
But I think you're 100% right. I think it's still super new.
Yeah, like I talk to advisors, friends, people, colleagues I know, and we talk about Bitcoin, and we have this engaging conversation about it, and they talk about it and they know it, and then I say, well, what kind of a weighting would you put in a client's portfolio? And they're like, oh, I don't buy it for clients. I only
Yeah,
buy it for myself.
yeah.
Like, well, what am I missing about this conversation that we just had? And I certainly won't be naming any names, but it's true. So
You should name them right now. It'll be good for business. Bad for
um,
compliance.
yeah, exactly. So I think that it's still so early and still so early from the places getting comfortable with it. The one thing that I think we've talked about this week, at least off camera, is that Bitcoin this week has been super stable. You've had volatility coming down. You've also had kind of so Keith from Hedge Eye talks about implied volatility, which is another beast altogether. But you have, when implied volatility is really high, it tends to signal that there's a potential upside move still ahead. And so you've had kind of low volatility, high implied volatility. It get kind of a setup that says things are pretty calm right now. And so, I'm wondering what and how that's going to play out. I mean, you pointed out the wedge technical chart there about a week ago, and so it's peaked kind of above that wedge on the technical pattern. So certainly something there maybe we need to pay attention to, but I think if they turn on those ETFs in the US, it could be interesting. Gold, which I think we've talked about at some point, there's no way for people to invest in gold in the 80s. And so, when GLD first came to market, which is the gold index, GLD, is that gold went from 400 to 1800 in the matter of about 2 years, so you got a triple from it.
Mm.
So if not saying the same thing's going to happen, but if you do get that where you make it readily available for people and they can start to allocate towards it, it's not unheard of where people start talking about these numbers of a couple $100,000 a coin. If you
Mhm.
get institutional money, if you get everyone start to allocate it, if you get the banks say we're taking X percent weighting into our asset allocation models, and I know we'll talk about asset allocation later, but that's where you get the pull and the money come in.
Yeah, it'll be interesting to see how it compares to gold because in that, looking back at that, was there other ways to invest in it? Like what was there the Coinbase for gold, right? Where people there's already billions of dollars invested in it in some way or another, right? And the
Sure.
other factor is to consider too that things move 10 times, probably 100 times faster than they did back then. So
Yep.
that 2 years to triple, maybe 6 months, maybe it's not, right? We,
Yeah.
we don't know
Yeah.
that, but it'll be
Yeah.
interesting to see that comparison if that's actually
Yeah.
happening. To me, it's
Yeah.
more
So,
of a comparison of the internet than it is to gold. I know people like to compare it to gold, but it's
yeah.
because where you see those massive spikes in all the companies that started, right? So I think we're gonna see the same thing.
Yeah. Yeah. So, and I think the investor profile is very different too, right? Like, I attended Credit Suisse. They did a gold versus Bitcoin this week, and they had a couple of interesting speakers there. And I do think that they're in different worlds presently. I think the worlds will collide. But right now you got gold, which, a lot of people want to compare the two, and I think they're completely different. But yeah, gold still, this is still like an institutional type tool. This is kind of the institutions use it. Like that's where you would get allocations right now. And, it's a different. They can touch it, they can feel it. The people running those monies are still the boomers, still the older generation. They're still running that asset allocation, so they're still buying gold from that perspective. Where you look at the crypto Bitcoiners, like the maximalists, you know what they own in their portfolios?
No.
Crypto. That's it. They
Right.
own Bitcoin, they own Dogecoin, they own Litecoin, they own the 100% crypto allocation in their portfolios,
Wow.
right?
Seems smart right
So I
now.
mean,
Seems like a smart play right now.
yeah, and I think we can cover concentration
We
at
will.
another point as we will.
We will.
But like those worlds haven't collided yet, and
Yeah.
so you got the kind of the two paradigms there, and I think that you and I know from working within an financial institution, like their level of understanding of something before they're willing to be comfortable with it as an allocation needs to be really high. And
That's an understatement. Really high is an understatement. You know.
mm,
Yeah, they're definitely going to be the last ones to the party. Let's
yes,
just say that, right?
yeah,
So, which is crazy to me, but we're still learning here.
yeah.
Speaking of comparisons, my favorite comparison is when people
What's that?
compare Bitcoin or crypto to tulips,
Yeah,
right? The tulip
yeah,
market.
yeah,
That's insane. It's not the same at all.
yeah,
They think it's
yeah.
because it was so speculative or whatever, but I guess those are the people that really believe that history repeats itself, and I don't think we're in that
Mhm.
camp where I don't believe at all that the past dictates the future whatsoever, especially in this day and age. The patterns are just so inconsistent. I don't even know how you can make an argument for that. And to compare it to tulips in 2021 is asinine.
Yeah, I had a good banter there on LinkedIn with a former colleague about that, his comparison. So go check that out if you want. But yeah,
And
I
there's no
would
shot
agree.
that he listens to this. He still gets his news via smoke signal. Hey, he still has horse and rider bring him his
Yeah,
annual
yeah, yeah.
reports.
Yeah, well, listen, lots of the technicians, a lot of the people that have that kind of CFA type of upbringing, and nothing against CFAs are brilliant people, but you need data, you need the input. Like unless you get history, unless you can show me like 30, 40 years of history and back test it, they can't get comfortable with investing in an idea. So, I get the comparisons to tulips, and in fact, when in the last run up before you could actually buy it, before there was futures trading on it, I said it was a bubble, and it was a short term bubble. It's bubbly, for sure, but the different comparison is that a whole financial infrastructure is being built around this, where tulips was bubbly and there was nothing happening behind the scenes, where all these major companies are building financial infrastructure to do it. You got every central bank in the world trying to figure out how to set up digital currencies. So, while the price might be a bit something speculative that you're concerned about, but comparing the two is not, I don't think is legit.
Exactly. Okay, well that's our weekly cheerleader session on Bitcoin and cryptocurrency. Let's move on. You did mention Kathy Woods
Yeah.
briefly there, which moves us on to Shopify, which she actually says is the next Amazon.
Hmm.
So, that's yet to be seen. But the interesting thing that happened at Shopify is they parted ways with three of their top executives. And because of that, the stock went up. Had a nice little run there. So it's interesting because the way they're painting the picture on this is that it was mutually agreed upon, and both sides, all three people that they or let go or quit or whatever, decided it was best for them and for the company, which to me is something more happened there for sure,
So
right?
yeah,
There's no way
yeah,
you lose three of your top executives and something didn't happen there. That being said, it may have been a leadership from the CEO that says, okay, we've hit a bit of a lull here
yeah,
in our talent and our
yeah,
technology, because those are two of the roles that they're replacing, right? A bit of a plateau, and we want to bring some fresh blood in here, which, as far as from what I know of corporate and company life cycles, you can't have the same group of people developing company for your 10, 20 years and expect new fresh ideas all the time, right? So
yeah.
I think it's a great move no matter what happened. And then the results was obviously the stock going up. So why do you think in a
Yeah.
situation like that, doesn't it point more to turmoil, and shouldn't the stock go down?
Just wondering what you would do too. Like if they told you you're like chief talent officer of this multi-billion dollar company and they tell you you're fired, are you going to issue a nice gentle press release like that, or are you going to say something else? Just curious your comments, and then I'll give you my feedback.
Well, if it's me, obviously depending on a lot of factors there, but yeah, if they just told me to get lost, obviously I wouldn't do that. But I'm sure there's a lot of factors at play there. It's probably with a lot of dollar signs behind it. So if that's the case, hey, I'll be happy to do what's best for the company.
Take your medicine, yes, and hit the road.
Exactly.
Yeah, yeah.
Exactly.
Yeah, so it's actually they actually have four now because in September of last year, their chief product officer was resigned, let go, whatever, and
Yeah.
Toby took over the job apparently.
Right.
So yeah, then chief legal officer, chief talent, and chief product. Like the only other thing could have been, I guess, COO and CFO. I mean, those are the only two other C-suites, and that's I think if you saw the CFO exit at the same time, I'm guessing they probably had to pay them a lot more so that they wouldn't.
Hmm.
But you'd be concerned about the financials. Yeah, I don't know. I mean, the chief talent officer, so I've followed her a little bit, and she was like employee number 20 or something. So like these are people that have been with the company for a long time. So I think your point's valid. I think it's probably a combination of Toby, a combination of the board saying we're in the leadership role right now, and if we continue to be stagnant, we're going to miss out on an opportunity that we have here. It's been, I've followed Shopify from the start, and it isn't something that I've participated in. I own it for a couple of clients, but I've come around on it. I saw the first and one of the kind of early pitches. I talked with a venture capitalist about it when they were first coming out, and some of his words were the ones that kept me away from it, saying, their product isn't that unique. They just have good delivery, and they're in a leadership role. And I think they've grown that portion of it, and now I think that they've established this giant network where they control commerce for so many different businesses now. Now that they've established that, now they need to do something truly unique, and that something truly unique is what you're talking about. Is how do we integrate? How do we become that DeFi leader? How do we make sure that we can do all of these things, take crypto as payment, like find a way to integrate this into our system and maybe become a bank like and Kathy Wood's been bang on, and she certainly sees the world a lot differently than many people, and so I think she's got some valid points. But Shopify I never really thought of as finance, and I'd heard rumblings and musings about it from other people, but they've really come a long way. I do think if we get a slowdown that I'm expecting mid-year to late year, we see we see an opportunity to reload and actually buy this position. But certainly Kathy's been exceptional, and her views and takes on what and how this works.
Right.
Yeah.
Yeah, it'll be interesting to see. It'll be interesting to see what happens next. I mean, usually when new leadership comes in, they have a whole new direction, right? And, so, which is usually exciting, right?
Yeah, look, I mean, I think they probably want to pivot that business and be really a finance tilt. Like I think
Yeah,
they want probably some of that. Like how do we do this? Like how do we
yeah,
bring how do we bring somebody in that can sit in both worlds? What's existing finance look like now? What does the new age look like? And how do we get this to come together? And how do we be the leader in that space?
yeah. I love to see it when companies do this still on the way up. You know, when they make changes and they don't wait for that turnaround moment, right? And they just hold on too long to their talent and their ideas and their vision, right? And I think that's why you see some of the founders exit when they do too, you know, on the way up. They're like, I realized my vision of this company. There's nothing more I can do here. And then somebody comes in, breathes new life in it. And I think too, sometimes that giving that opportunity to the founder to step away from it. That's why you often see them come back, right? And
Yeah.
then make other
Yeah.
changes because they get to step away from it, see what so that new ideas are coming in, and then have, because they've been away from it, have a fresh new perspective on what it could be, and then they come back and contribute in some other way. So I think it's good
Yeah.
on them if that's exactly what they're doing. Hopefully that's what they're doing. It's not some sort of scandal. We'll find out. It's 2021. It'll be on TMZ or
Yeah.
something. What's the
You
Ottawa
can't
version
hide.
of TMZ?
You can't hide,
The
that's
Ottawa
for sure.
Sun. Right? Yeah.
Does that still exist?
Yeah, I think the Ottawa Citizen
It
bought it,
does, eh?
didn't it? Yeah.
Oh yeah.
I don't know. I haven't read
I
that since I was a teenager.
my my neighbors are older and they still get their paper delivered every day. So I see the
Yeah.
guy pull up and throw the paper and bounces off the door.
Yeah.
It's a nice old school moment for me each day.
I do, and maybe I'm kind of old school like that. I do like the idea of a newspaper. Like I used to read it every day too,
Yeah.
and that was the only
Yeah,
thing when I
yeah,
was
yeah.
like late teens, early 20s, and I like
Yeah.
doing it. You know, I got the Globe and
Yeah.
Mail, I got the Wall Street Journal, like, I
Yeah.
got all those things.
Yeah.
But anyway, okay, well, yeah,
I'm with you. I love
interesting.
the
I like
paper.
what's that?
I love the paper too. Like the Financial Times has like a pink paper. So I
Yeah,
used to get the Saturday Financial Times. It was fun to read.
yes, yeah, I know it's great.
Yeah.
I kind of miss
Yeah.
it. You know,
Yeah.
like same thing. I've never been able to move to like a Kindle. You know, I just like
Yes. Yes.
regular books. You know,
Yep.
but
Yep.
that being said, I do consume 95% of my information in digital format. Big
Right.
podcast and audiobook guy because I can
Yeah.
do that on while I'm doing other things. But yeah, for sure.
I love
Okay.
the reading still. I like the books, I like the hard
Yeah,
books.
yeah,
Yeah.
for sure. Okay, let's keep it moving here.
Hmm.
Let's talk about the Roaring Twenties, right? And how why are people comparing this time to that time?
Yeah, so there definitely is a lot of similarities, both from a financial setup perspective as well as from a income divide perspective. So you had that period of time where everything was getting inflated. You get asset prices, people were spending in excess, things were growing, things were overvalued. It looked like everything was perfect. And so, for example, today I listened to the CIO of CalPERS, which is one of the largest pension fund managers in the world. They're California Teachers Pension. And so their CIO today said, like, this is a nirvana. Like, this is the time you want to be an investor. He actually said this is nirvana. Like, he's like, almost like this is easy. He had Larry Fink come out today, who's the CEO
I saw
of
that.
yeah, Blackstone, right?
Yeah,
And he said market's going up, and we took in another close to $1 trillion of assets. Let's go! Like
yeah.
these guys
What could
think
go
that
wrong?
everything's
It'll be fine.
yes, exactly. And so a lot of similarities. That's the same thing. Like things were great. People were spending money. Like everything was awesome. Everything was going up. And so I think there's a lot of similarities from that perspective. And so what ends up happening though is you get, which we've talked about a little bit of these kind of fourth turning, these long tail cycles. This is typically the end of this euphoric period where things get overinflated and people overspend. And it's a, from that perspective, if you're a carefree, I don't manage money perspective, just live life and spend and things are going to be great. That's where a lot of the comparables come from.
Interesting. And as it relates to inflation,
So there's different kinds of inflation, different obviously angles, and so I think that if you read consensus is we're in this next wave of inflation, and we should expect everything to go up, prices to go up across the board. And so, I don't think it's a one-way street. I think we're in this kind of transitory period where we're getting inflation and kind of the CPI type bucket things, which is energy, materials. Again, all of these things are constrained because of manufacturing. We also have year over year numbers are huge because 12 months ago at this time, the world was completely locked down. So you're getting these inflationary numbers. And so got these inflationists think that everything's going to go up, up, up forever. And so, I think one of the things that we're seeing though and so I think that's going to be different than what was in the 20s where you had inflation kind of in everything at the same time. You had a different demographic setup than we have today. But I do think you probably get asset price inflation, but that doesn't flow into CPI. Like the one thing I think we're not going to see through this is we're not going to see wage inflation, or maybe we do, but I'm not sure how. Like unless you have any ideas to tell me how we're going to see wage inflation, I'd be shocked. So, as a result of no wage inflation, you're not going to get this kind of lower middle class start to come up, right? The only people that are benefiting is the top income earners and the top asset owners, right? So if you get asset price inflation, which is what the Fed and the central banks of the world are targeting, like the top 1% of the world are getting all the benefits because they own all the assets. So if assets go up, houses, boats, art, and the stock market, you're going to get the top 1% go up a lot. And if you get wage deflation, which I think is quite likely as a result of all the technical advancements, is you're going to get sideways to down wage inflation. So you get that's a nasty cocktail for kind of that fourth turning setup, which is where you get kind of the millennials saying, wait a second, we're in this bottom bucket. We don't see any way that we get out of that. We need a pretty material change in life. And so, I think that's what's likely is asset price inflation, but deflationary things and everything that would go into CPI.
so that's just inevitable? Like that's going to happen, and what's the way out of that? If I guess that assuming it's a bad thing, right? I mean, it is a bad thing. I'm not saying it's not. It absolutely is. But so what? We're too far along to avoid it. I mean, it is happening, right?
Yeah.
So, like you said, like just material change from a standpoint of people have to change their habits in order to make to jump the gap, or is it on government to find a way to bridge the gap through the
Universal
minimal, what
basic
is it called?
income or something.
Yeah,
Universal
universal
basic
basic
income.
income.
Yeah.
Yeah. So what do you think is the remedy to that? If we call it a remedy, I guess.
Yeah, I don't know that there's a simple solution to it. I think that you get uprising, and we're seeing that now. Like you're seeing that already. I think you're seeing that kind of come through, and this universal basic income, it definitely isn't a solution because that ends up resulting in more debt. So I think it's maybe in their eyes it would be a solution, like give us a guaranteed basic income and we'll leave you alone. I think that's temporary, but I think what you probably get is you get more of we want to take charge. How does it play out? I don't know. You get like the millennials right now are kind of hitting that late 20s, early 30s. Like they're starting to get into that point where they want to buy houses, and this is a big demographic. Like this is bigger than you and I for sure. We're
Hmm.
Gen Xers, so like this is a big demographic of people kind of coming into the system now, starting to make money. Some of them made money with crypto, starting to have more influence on the world. Like, this is the generation that's going to, somebody in there is going to come, I don't know who it is going to come out and, find a way and they'll just say enough. And I think you see kind of a massive change to kind of the global control structure because right
Hmm.
now it's still controlled by the boomers, and they want to do what they know, and nothing wrong with that. Is they know how to print money, cut interest rates, and hope that's going to stimulate the economy. But when you got a 1,000-pound gorilla on your back, which is all the debt, you know, no matter how much more you pump into the economy, it's not going to be enough to keep going.
Yeah. Well, it seems like, over the years with all the disruption in all the different industries, it certainly seems like finance is up to the plate now, right? So if there was ever a time we're going to see a disruption in anything like that, I think now is the time. And now being the next, 10 to 20 years, there'll be a disruption. And what that does to the classes of the world, who knows? But
Hmm.
I agree, like there could be a complete turnover in those classes. I don't know if it'll bridge the gap, and I don't know if we'll get that coming together of classes. But if there was ever a time, I think you know this is kind of the
Yeah.
age of it.
Yeah, so that's where you see tax, right? Tax is going to be a big one, right? So you could see them go crazy and say, if you have a net worth of over 5 million, you're going to pay tax at 90%.
Yeah, I
And
hate to see
yeah,
that because then it's just you take everybody's motivation away, and then it just becomes Atlas Shrugged. I don't know if you read that book or not, but
of
that's
course.
that's worth a
Yeah,
read. Since
yeah.
we're being controversial on this podcast today, that is like you take the motivation out of the leaders of the world, and that's what's going to happen, right?
Yeah,
So
yeah,
even though I'd love to see that divide come together, I don't think excessive taxation is the way to do it
yeah,
because then people either just find a way around it or they just lose their motivation at all and say screw this. I'm not
yeah,
Why am I going to
yeah.
build these massive companies and have provide all these job opportunities for all these people when I'm just going to get taxed to death, right? It makes no sense.
Yeah, so I think the likelihood is not that we're not gonna see that. I think we're more likely to see at some point. Well, we've had Yellen talk about universal or a global corporate tax, try to make a global corporate tax rate so that all the countries are the same.
Hmm.
I don't think that'll happen. I think we'll probably get some kind of debt jubilee, or they'll just do like Japan, which is bring rates down to zero and essentially make their debt currency, and so kind of try to wash their hands of that and kind of a restart. We've had Biden already talk about forgiving a bunch of student loans. So I know there's trillions of dollars in student loans in the U.S. and they'll just forgive it. So, you know, I,
Jeez, could you imagine that?
yeah.
I don't see
Well,
that happening, but whatever.
well,
I mean,
he
who knows? Who knows?
yeah. So they're doing things like that, and so, but the one of the questions you did kind of hinted at was, how do you get how do you get inflation? And so I think as the central banks talk about their digital currency, that central bank digital currency, that's how you get inflation, right? As if they set up their link to your bank account, they want to put 5 grand in your bank account and give you 90 days to spend it. Well, that's one certainty that you're going to spend that money. And so if you're going to spend that money, well, at least North Americans, they're going to spend the money, is you're going to get inflation. Like people are going to spend it.
For
Um,
sure.
yeah. So,
Yeah, yeah, they're gonna spend it on whatever, right? I mean, I hate to say things like that because there are people that really need it and they do spend it on things like food and
They need, yep,
rent and stuff like that, right? They need
yeah,
it, but
yeah,
there's also that large group that go and spend to buy TVs and
yeah,
consumer goods and whatnot, right? And there's the other
sure.
group they go and buy crypto with it, put it in put it in the market, and those are the ones that are actually benefiting right now, I guess. So yeah,
Yeah, yeah. Yeah, so I don't know where we started on that. I think we started talking about Kathy Wood and then we went down
rabbit
that
hole,
rabbit
rabbit
hole.
hole, man, rabbit hole on inflation.
Yeah.
Okay, well let's move on to our last topic of the day, which is diversification.
Yeah.
Uh, I started off with saying, with hinting at a quote from Charlie Munger that diversification's for idiots.
Yeah.
Uh, you know, I don't know what you think about that, but yeah, let's just start with that. Why would he say that, first of all?
Yeah, I mean, they've always ran a concentrated portfolio, and
Hmm.
it's true that history has shown that concentration results, if you're good at it, in better results, right? Like you have the potential to build massive wealth if you're right. The number of Charlie Mungers in the world are one. So, and
Right.
Warren Buffett are two. So, I guess you can, I think for every one or two people that you can point to that have been successful at that, I can point to 100 that haven't been. And
Hmm.
so, one of the richest guys in the world was in Brazil, and I'm drawing a blank on his name right now. He was worth, I think, something north of 60 billion at the top, personally worth that. And he stayed with it, didn't diversify, didn't buy other assets. Oil and gas guy, oil and gas started to sell off. He put more of his own capital into it, prop up the business, again, sell off, prop up the business, and he went bankrupt, personally bankrupt. The company went
Wow.
bankrupt and he went personally bankrupt.
Yeah.
And so, I think that there is some thinking if you're worth $60 billion, maybe take 10 off just in case you're wrong.
Yeah.
Yeah.
Yeah, that reminds me of a quote, like, as far as diversification is concerned with, I think I heard somebody say, like, you should look at it depending on what stage you're at. Like, if you're trying to get rich or you're trying to stay rich,
Yeah.
right? So that guy got rich by not being diversified, right? Being
Yep.
concentrated.
Yeah.
And
Yeah.
basically, there's a lot of luck involved with the not diversifying. You got to pick a winner,
Yep.
right? Like
Yep. Yep.
you're putting your marker on number 17, black. You
Yeah.
know what I mean? And
Exactly.
that's the one that hit and you
Yeah.
got rich, but that's then the time to diversify to avoid risk, right? And
Yeah.
that's
Yeah.
essentially what we do every day.
Yeah, so I'm reading Annie Duke's book. I don't know if you know her. She's a famous poker player.
Yeah.
And yeah, so she talks about spreading around your bets, right? You want to be successful, you spread them around, you take appropriate risk reward, you get a strong hand, you lever up. Like it's about making good decisions and spreading around your bets at the right time. And so I would kind of view it more that way.
Mm,
I don't think you want to own. This is why I'm against owning, just a passive ETF, for example, because, if you own a basket like, one of the robo advisors baskets of ETFs, you probably own 5,000 stocks.
mm,
Well, I think that's too many.
yeah.
But, if you own 100, okay, that's probably reasonable. Like maybe that makes sense. And then you would weight your bets. Maybe you have a 3% weighting in one thing and a 0.1% weighting in something else.
Hmm.
So the 3% weighting has 5% upside. The 0.1% rating has 1,000% upside. I think about it more that way when I'm thinking about diversification and kind of spreading your bets around.
Gotcha. Gotcha.
Makes
Yeah,
sense.
I mean, it's interesting to see if what we've talked a lot about millennials during this
Yeah.
episode, and it'd just be interesting
Yeah.
to see what more the appetite is, because I think the appetite to wait longer for returns is like that long view is getting
It's
shorter and
fading.
shorter, right?
Yeah.
And people like,
Yeah.
oh, they're not going to be happy with a 3 to 5%, right? Like, okay, well,
Hmm.
how can I double my money? You know,
Yeah.
it's like
Yeah.
that type of mentality now. So it'll
Yeah.
be interesting to see as those come in and become more of, you're like, let's not include those in your GameStop investors and those types of retail investors, right? The one hit wonders, but
Right.
what people's views will be on diversification moving forward.
Yeah, so I think it'll be interesting. I mean, hopefully we can continue to educate people around how returns look like and how, there is kind of a general thinking that bonds are dead. And I continue to rail against that because, bonds provide certain things at certain times, depending
Yeah,
on where you are in the cycle. Like I said, like last year, the long bond was up 20%.
yeah,
Like it was the best performing like major asset class, and I strip Bitcoin out of that, of course. But
hmm,
like of the traditional major asset class, that was the best one. It's given a lot of that back this year, and probably makes sense to have an allocation in portfolios again. Because if the market rolls over, well, I know everyone thinks it can't.
hmm,
That's going to provide you a great risk reward, where you have the chance to, people look at it and they're like, well, 2.3%. Why would I buy a 30-year bond at 2.3%? That's stupid.
yeah,
But if the yield drops 50.5%, you're going to make your 15-20% upside. So,
yeah,
so there's still good places to make money in the bond market. There's still places to make money in equities. But I think you're right. I mean, I think it'll be interesting to see how it plays out from expectations. Um, and as we have millennial clients, and
yeah,
I think it really depends a lot around what they've done, how they've grown up, what they think about. But if you have a client that is expecting 20% returns, which a lot of them do because they see that as a potential,
hmm,
um, you know, that is quite a different risk reward. You're not buying a balanced portfolio and getting 20%. I just went through and did financial projections with a client, and our financial planning department pulls data from the different tools, and they use like this kind of Monte Carlo simulation to generate expected returns. And their present expected return for aggressive growth portfolios is 4.2%, right?
wow, yeah,
Yeah, I was
wow,
shocked. Yeah.
yeah, yeah. I mean, and that's just that satiates people's you know appetite for investment, right? Like, oh,
Well,
four point
I
two
mean,
percent.
maybe, but they're going to have to save a lot of money.
Yeah,
Like if they expect to retire and that's the going to be what the return profile is going to look like, they're going to
y-
need to
yeah,
save a pile of dough.
yeah, definitely.
Yeah. Yeah.
Yeah, millions,
Yeah.
millions. It's crazy.
Yeah.
And yeah, I don't like that brings up a whole other conversation we won't get into today, but like, is
Yeah.
are we a generation and the next generation's going to be as good of savers as the boomers? Probably not, right? Just that need,
Mm.
that instant gratification, right? So are they going to save $3 million for retirement, right? So they can get that 4%? Probably not, right?
No.
So some will, but yeah,
Yeah, some will, and there is a big wealth transfer to happen, and so there is certainly, if you're planning, there you could the boomers, if they put a good plan in place, if they have life insurance, they have a number of these things set up, there could be a good transition, but I'd say it's fairly unlikely that they're going to save en masse like that.
yeah,
Yeah,
yeah, it's true.
yeah, yeah,
Who knows? That's why I love this industry, man. You
yeah.
don't know. Every day is new. Who knows what tomorrow's going to bring? Right now, we're in the roaring 20s, so let's just live it up, Ben. Hey, I'm just trying to buy a bike online. I can't even find that. So, roaring 20s, I'm
Yeah,
not sure.
yeah.
Okay, cool. You got anything else before we end this epic episode?
No, I think it's been great. Lots going on. The more that I read, consensus is certain that everything's going to be great this year. So I think they're wrong. Continue to have my view for what's expected this year, which is a rocky middle part of the year. So right now, though, let's make money and let's keep it going.
Let's go. Okay, we'll see you for episode 16 next week.